Every time a government gets into trouble, someone in a suit appears on television and says the same calm sentence. The central bank will step in with liquidity. Since 2008, those calm sentences have added up to trillions of dollars, euros, yen, and pounds, created out of nowhere. No new factories, no new oil fields, no revolutionary inventions overnight. Just numbers on screens, expanding silently in the background. You didn't see printing presses running at full speed. Your paycheck didn't suddenly triple. Your bank didn't call and say, "We accidentally credited you a few $100,000. Oh, yes. And yet somehow, the biggest players in the financial system got rescued. Markets soared to all-time highs, and governments kept borrowing as if gravity no longer applied. So a simple but unsettling question hangs in the air. If central banks can create trillions from thin air whenever they decide to, what exactly is quantitative easing, and why isn't it simply called counterfeiting? Quantitative easing lies at the point where money, power, and trust collide. Most people grow up thinking of money as something solid and scarce. Metal coins, paper notes, the balance in a bank account backed by the economy. But modern money is not a pile of gold in a vault. Modern money is a web of promises, debts, and claims on the future. QE is the process of stretching those promises further than most people realize is possible. Governments describe it as stimulus. Economists call it unconventional monetary policy. Market commentators call it injecting liquidity. Strip away the language, and the core reality is brutally simple. The people who control the money printer buy assets with money that did not exist the day before. No one had to work for it. No one had to save it. A decision is made, numbers change, and the financial universe quietly rearranges itself. To understand how that became normal, it isn't enough to start in 2008. You have to go back a bit, to a country that hit the limits of traditional monetary policy before everyone else. Not the United States, not Britain, Japan. In the late 1980s, Japan was floating on a massive asset bubble. Stock prices were insane. Land in Tokyo was famously valued as if a few blocks were worth more than entire countries. Then the bubble burst. Through the 1990s, Japan faced something the modern West had almost forgotten: deflation. Prices stagnated or fell. Growth slowed. Banks were trapped with bad loans and fragile balance sheets. The government tried the usual remedies. Interest rates were cut again and again, all the way toward zero. Public spending increased. But the engine refused to roar back to life. By the end of the decade, the Bank of Japan had reached the floor. You can't cut interest rates much below zero, at least not under the old rule book. So they tried something new. Instead of just controlling short-term rates, they began buying long-term government bonds in large quantities. Not with tax revenue, not with the savings of the population. With freshly created central bank reserves, electronic money that only commercial banks can hold. They didn't yet give it the slick label quantitative easing, but the blueprint was there. If you can't cut rates any further, you try to push investors out of safe assets by buying those assets yourself. By purchasing bonds, you raise their price and push down their yields. When yields on safe government debt fall toward zero, investors searching for returns are nudged toward riskier assets. Stocks, corporate bonds, real estate, anything that promises more than nothing. The hope was straightforward. Bond yields fall. Investors get impatient with low returns and move into risk assets. Prices rise. People feel richer. That wealth effect is supposed to encourage spending, hiring, and investment. In theory, the economy wakes up. In practice, Japan drifted into a long period of weak growth and low inflation. The patient didn't die, but it never fully recovered either. QE had prevented collapse, but failed to restore the boom. The rest of the world looked at Japan as a kind of strange laboratory. They took notes. They muttered about liquidity traps. And then, as long as their own economies were humming along, they put the playbook back on the shelf. Until 2008. In 2008, the global financial system didn't just wobble, it nearly stopped breathing. The world discovered that supposedly safe instruments, AA-rated mortgage securities, trusted banks, complex derivatives, were built on fantasy. One major institution failed, then another. Credit markets seized up. Trust, the invisible oxygen of a debt-based system, vanished almost overnight. Central banks responded in the familiar way. They cut interest rates. Then they cut them again. Then they slashed them to near zero. And yet, banks were still hesitant to lend, investors were terrified of risk, and money rushed into government bonds as the last perceived safe harbor. The system was paralyzed by fear. So the Federal Reserve in the United States, the Bank of England in the UK, the European Central Bank in Europe, and others reached for Japan's tool, but on a far larger scale. They gave it a crisp clinical name, quantitative easing, QE1, QE2, QE3. Later, in response to the COVID shock, something even bigger and faster, QE on steroids. Headlines spoke of hundreds of billions, then trillions. The words appeared on screens as if these numbers were just another statistic. What actually happened was far more radical than the calm tone suggested. On paper, QE is almost childishly simple. The central bank announces that it will buy a certain quantity of assets, usually government bonds, sometimes mortgage-backed securities or other high-grade instruments. It buys these assets from banks, pension funds, insurance companies, and large financial players. In return, it pays them not with existing money, but with newly created reserves. Those reserves are electronic entries at the central bank, liabilities of the central bank, and assets of the commercial banks. At that moment, no taxpayer explicitly hands over anything. No voter is directly consulted. No explicit budget line is debated in Parliament. On the central bank's balance sheet, it is just a swap. We owe the banking system this many reserves in exchange for we now own this many bonds. From the outside, it looks like magic. On the inside, it is an accounting operation authorized by law and protected by institutional trust. The difference between QE and counterfeiting is not mechanical. If an individual created money in a basement and tried to spend it, that would be a crime. When a central bank does it according to approved rules, it is called policy. The printing press did not disappear. It was simply made invisible and moved into the digital realm. If trillions are being conjured up, a natural question follows. Why didn't everyday prices instantly explode? Why didn't the cost of groceries or gasoline double overnight? Part of the answer lies in where the new money appears and what it chases first. QE money does not begin in the pockets of ordinary people. It starts at the top of the financial system. When the central bank buys a government bond from a fund, that fund now has cash or liquid claims instead of the bond. The bond's price has risen, its yield has fallen, and the central bank holds it as an asset. The owner of the bond has more liquid funds and fewer safe assets. But that investor still has targets to hit. Pension funds need returns to meet future obligations. Insurance companies need income to match their promises. Large institutions cannot simply sit in cash earning nothing, so they move out along the risk curve. They buy corporate bonds, stocks, real estate, private equity, anything with a higher yield. The first and most dramatic effect of QE is not a surge in consumer prices, but a rise in asset prices. Stock markets lurch upward, corporate borrowing costs fall, real estate in desirable areas climbs relentlessly, luxury assets appreciate. Charts look beautiful for anyone watching the indices. The question is, who owns most of those assets? The answer is predictable. Not the median wage earner struggling to build a basic safety net, not the young renter trying to buy a first home, not the person holding a modest bank deposit. The people who benefit most from QE are those already positioned near the top of the financial pyramid. Quietly, without a single tax bill landing in a mailbox, a transfer takes place. From future taxpayers to current borrowers, from savers earning almost nothing on deposits to borrowers paying almost nothing on huge loans. From the many who live mainly in the world of salaries and expenses to the few who live mainly in the world of capital and leverage. Every policy creates winners and losers. QE just hides them behind balance sheets and market jargon. The winners are clear. Governments that can borrow massive sums at historically low interest rates, corporations that refinance and buy back their own shares, banks and funds that see their holdings supported and sometimes directly purchased by central banks' wealthy households whose portfolios of stocks and property swell in value. The losers are just as real, but easier to ignore. Savers watching their deposit rates sit near zero while asset prices sprint away. Young households priced out of housing markets inflated by cheap credit and speculation. Workers whose wages crawl while the cost of buying into the asset-owning class accelerates. Entire generations who discover that playing by the old rules of save steadily and you'll be fine no longer leads to the same destination. This is why some observers call QE a form of hidden taxation. There's no law passed that says we will take X% from your savings. Instead, the value of cash and low-yield assets is silently eroded relative to the prices of scarce assets. The rules of the game change, and those who didn't realize the game was being rewritten find themselves standing still while the floor moves. There's another consequence of QE that reshapes the entire psychology of markets. When central banks repeatedly step in to buy assets during crises, they send an implicit message. If things get bad enough, we will rescue the system. Investors internalize this as a kind of safety net, the famous central bank put, the belief that losses will be limited because authorities will eventually intervene. The result is a slow but powerful shift in behavior. Risk begins to feel less dangerous. Companies load up on cheap debt, assuming they will always be able to roll it over in forgiving markets. Traders and funds take larger positions, confident that if they all rush for the exit, the central bank will act to restore order. Governments stop worrying about deficits as long as bond yields remain low. Over time, the entire structure becomes dependent on the expectation of support. QE was introduced as an emergency measure meant for exceptional times. It has drifted into becoming part of the permanent architecture, and the more the system leans on it, the more fragile it becomes. Asset prices rise to levels justified only in a world of endlessly cheap money. Companies survive not because they are efficient and productive, but because financing is easy and refinancing is assumed. Economies become populated with zombie entities that stagger along, unable to thrive, but also unable to die as long as the drip of low-cost credit continues. Then one day, inflation arrives. After years of subdued price growth, a combination of supply shocks, fiscal stimulus, and long-running monetary easing pushes consumer prices higher in a way that can no longer be brushed aside. Suddenly, the calm assumption that central banks can print at will without consequence looks less certain. When inflation steps above comfort levels, central banks face a dilemma they created themselves. Their balance sheets are huge. Their bond holdings are enormous. Interest rates are at or near zero. To fight inflation, they must raise rates and slow or reverse QE. They must drain some of the liquidity they previously injected. When they do, the world built on cheap money begins to wobble. Higher interest rates mean lower bond prices. Governments see their debt servicing costs rise. Heavily indebted companies feel the squeeze. Households face more expensive mortgages and loans. Markets that were priced for endless support must adjust to a world where support is conditional, slower, or even withdrawn. Volatility erupts. Underneath the day-to-day drama, a deeper truth emerges. If an entire financial system feels stable only when central banks are expanding their balance sheets, then stability itself has become dependent on permanent intervention. That is not a healthy marketplace. It is a patient who looks fine only as long as the IV drip never stops. Here lies the central paradox of the QE era. Money can be created in astonishing quantities with a keystroke, yet it feels persistently scarce at the bottom. Official statistics show balance sheets exploding, but everyday experience shows wages grinding and the cost of real security climbing out of reach. The reason is not just how much money exists, but where it enters and what it pursues. QE begins at the summit of the financial mountain and cascades downward unevenly. It inflates the value of existing assets first, and most dramatically. Only over time, and often distorted by speculation, does some of that wealth trickle into the real economy of jobs, salaries, and goods. If you are positioned at or near the top, owning diversified assets, benefiting from rising valuations, able to borrow cheaply to buy more, you live in one version of the QE world. If you're mainly selling your time for a wage and trying to buy your way into the club of asset owners, you live in another. The rules technically apply to everyone, but the effects are anything but equal. None of this is entirely new. History is filled with systems that discovered ways to create money from nothing, at least for a while. Roman emperors shaved silver off coins. Medieval rulers debased their currencies. Revolutionary governments printed paper until it became worthless. Each time, there was a story about why it was necessary, why this time was under control, why the cleverness of officials would prevent disaster. The mechanism changes, the technology improves, the language becomes more technical. But the underlying pattern repeats. Promises are stretched, claims multiply, and those who trust too much in the permanence of money discover that what really matters is who holds real assets and real power when the illusion thins. Quantitative easing is presented as a technical tool, adjusting the monetary base, stabilizing markets, ensuring transmission of policy. In reality, it is a profoundly political act disguised as neutral expertise. It decides which markets are supported, which institutions are stabilized, which debts become easier to carry, and which saving strategies become obsolete. Trillions have already been created from thin air, and more will almost certainly be created when the next crisis arrives. The press conferences will sound calm. The charts will be clean, the words will be familiar: stability, liquidity, functioning markets. Beneath those words, the same questions will quietly wait. Who receives the new money first? Who bears the side effects later? What will still hold value when confidence wavers and the spell loses its shine? Because in the end, QE is not really about clever formulas or exotic balance sheets. It is about trust. Trust in institutions to manage something so powerful without abusing it. Trust in currencies that no longer rest on anything tangible. Trust in a promise that this time, unlike all the others, the trick can be repeated indefinitely without a serious reckoning. History has a long record of answering that kind of promise. It does not answer politely. It answers with crises, resets, and painful redistributions of wealth from those who believed paper promises to those who understood their limits. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.